Imagine a world where fortunes vanish overnight. Wall Street is booming but suddenly crash, sending shockwaves across the world. Factories that are booming with activities fall silent. People's savings wiped out as banks crumble. Millions left jobless, hungry and dependent on free meals. This is the story of the Great Depression, a period of unequal economic collapse that shook the world. The Great Depression was the most severe economic downturn in world history. Millions of Americans experienced the dramatic shift from the prosperity of the roaring 20s to deep economic and social distress during and after the crisis. The stock market crashed, factories went still, banks collapsed, billions of dollars wiped out, and people waited in bread lines that stretched for blocks. And the crisis wasn't confined to the US. Its devastation eventually spread across the globe, creating a global crisis. But what exactly triggered the crisis? Well, the downturn wasn't caused by a single event. To better understand what caused the depression, let's go back in 1917. On April 6, 1917, the United States joined World War after Congress voted to declare war against Germany. Before the war, France and Britain were the leading economic powers in the world. Germany also emerged as a significant industrial power. However, after losing the war, Germany experienced a significant decline in its industrial power, after losing 10% of its population and 13% of its land, including areas rich in iron and coal. Britain and France also suffered significant economic hardships despite their victory. In contrast, America avoided the destruction that had damaged Europe because the war was not on their land, and thus they emerged from the war as the leading economic power. The war ended in 1919, marking the beginning of the Roaring Twenties, a period of significant economic prosperity for many Americans. As the economy experienced significant expansion, industries shifted from production of ammunition to consumer goods. Wartime devastation in Europe also fueled increased demand for American goods. Technological advances and innovation made after the war revolutionized manufacturing. Henry Ford, for instance, revolutionized the auto industry with the introduction of the moving assembly line. By 1925, the new Ford Model T rolled off the assembly line every 10 seconds. Also, there was mass production of other exciting products such as radios, washing machines, and vacuum cleaners, and much more. With factories adopting new technology, they could employ a huge number of skilled workers, and this created opportunities for even women to join the workforce. The increased disposable income and the easy access to cheap credit led to a surge in consumer spending on fashion, entertainment, and new technologies. This increased the demand for new goods and created more jobs for the Americans. Jazz music, flapper dresses, and lavish parties became iconic symbols of this era, representing a shift away from the traditional values and a newfound sense of freedom and prosperity. The stock market mirrored this prosperity, with share prices surging to new records. The Dow Jones increased sixfold, from 63 in August 1921 to 381 in September 1929. Stocks more than quadrupled in value during this period. More and more Americans, with their increasing income, started investing in the stock market due to the potential for easy and quick profit. It is estimated that 1 in 6 Americans was a shareholder by 1929. However, the increased investment in the stock market was mainly driven by speculation. Many investors were buying stocks only to sell them quickly at a profit rather than for long-term dividends. This was fueled by a practice of buying on margin, where investors could borrow money from brokers to purchase stocks. Buyers only had to put 10 to 20% of their own money and thus borrowed 80 to 90% of the cost of the stock. Of course, the significant leverage amplified the potential gains and losses in equal measure. This led to the market bubble, Despite the inherent risk of speculation, there was a widespread belief that the stock market would continue to rise indefinitely. However, as more investors relied more on speculation rather than sound financial principles, the stock prices increasingly became detached from the actual values and earning potential of the underlying companies. Availability of easy credit inflated the bubble as more people took loans to participate in the market. Eventually, the situation took a turn for the worst. Dow Jones hit a record high of 381 in September. However, warning signs such as declining production, rising debt, and overvalued stocks became apparent. This sent panic among investors, leading to a sharp decline in stock prices on October 23. But the real panic started on October 24, 1929, commonly known as Black Thursday. On that day, a record 12.9 million shares were traded as investors rushed to sell. Some investment companies and major banks tried to stabilize the markets by buying up large blocks of stock, a move that only had a temporary effect. The selling frenzy continued at even greater intensity the following week. On October 28, also known as Black Monday, the Dow Jones drops by 13%. The panic sale continued, with 16 million shares sold on the following day, Black Tuesday. The crash wiped out the savings of many Americans who had bought stocks on margin. As stock prices fell, they received margin calls requiring them to deposit more funds, a demand they could not meet, leading to forced selling and further price decline. And billions of dollars in market value was lost. Many investors were completely ruined. On November 13, 1929, the Dow dropped to a low of 198.6, down nearly 50% from the peak. But the worst was yet to come. The depression dragged stocks even lower in 1932. By July 1932, the Dow bottomed at 41.2, 89% loss from the peak recorded 3 years earlier. From the market crash, the Great Depression was caused by overproduction in the industry agricultural sector. At the end of the 1920s, the US market was saturated with consumer goods. Despite the prosperity, the majority of Americans were not rich. Who could afford to buy refrigerators, radios, cars, and vacuum cleaners had already bought them, while about 60% of citizens could not. This made the supply to exceed the demand. To make matters even worse, the demand for American goods in Europe fell. Even before the stock market crash, the agricultural sector in the US was struggling with low prices. As prices reduced, farmers were forced to produce more to support their families. The overproduction resulted in a surplus, causing prices to even lower. The overproduction forced many farmers to adopt poor farming practices, which together with severe drought caused the Dust Bowl. The severe dust storms across the farmlands in the Great Plains devastated the US economy. The most immediate effect of the stock market crash was bank failures. As the fear spread after the crash and the economy worsened, people lost confidence in the banks. They rushed to withdraw their deposits, fearing that their money would be lost if banks failed. The mass withdrawals depleted banks' reserves, forcing many banks to close. Businesses could not get loans, leading to mass layoffs. At the peak of the Depression, nearly 25% of the total workforce, or 12.8 million people, were unemployed. Prices and productivity fell, leading to lower wages, profits, and dividends. Factories were closed, mines and mills abandoned, homes and farms were lost, and millions of Americans went hungry. The rise in unemployment caused many families to split and move from their homes to shantytowns or Hoovervilles, named after President Herbert Hoover, who was blamed for the crisis. These shantytowns were built of scrap metals, including packing crates and abandoned cars. Millions of those who lost their jobs and savings could no longer afford food, And for basic survival, these people had to spend hours on bread lines that stretched for blocks, essential meals, often just bread and soup. Long queues of people waiting for food demonstrate the sheer scale of the economic hardship. The Depression affected nearly all countries in the world, leading to a significant decline in global trade and economic stability. And this spread is often attributed to the Tariff Act of 1930, which raised US tariffs on thousands of imported goods with the aim of protecting Americans' businesses and farmers. Other countries, including Canada and European countries, retaliated by imposing tariffs on American goods, causing global trade to plummet. Between 1929 and 1933, US exports fell by approximately 60%. This instability in global trade contributed to the rise of extremist political movement in some European countries, including the Nazis in Germany, which caused the World War II. Recovery from depression started in 1932 when Franklin D. Roosevelt was elected as US President. Roosevelt introduced the New Deal program, which focused on providing relief for the poor and unemployed. He established banking reforms, job creation programs, and social security nets targeting vulnerable individuals and families. Another critical part of the New Deal was the establishment of the Securities and Exchange Commission for the regulation of public companies. While the New Deal did not fully end the Depression, it laid the foundation for recovery. It was the start of the World War II in 1939 that ended the Great Depression. Massive government spending in preparation for the war ended unemployment as factories increased output. Automobile factories switched to making tanks, planes, and ships, and millions of Americans entered the workforce, reducing unemployment to around 1.2%. The US GDP doubled between 1940 and 1945. With the end of the war in 1945, the US became the world's leading economic power, and the Great Depression was over.